Edward Chancellor, Devil Take the Hindmost, A History of Financial Speculation. Embark on a fascinating journey through the history of financial speculation with Edward Chancellor's book, Devil Take the Hindmost. This book takes you back to ancient Rome, where the earliest forms of speculation began, and reveals how these practices have continued throughout history. Delve deeper into the intriguing world of financial bubbles, vividly illustrated by examples like the Dutch tulip mania, the South Sea scheme, and the stock market crash of 1929. As you explore the striking similarities between past and present speculative manias, the book unveils how these speculative tendencies are rooted in the pursuit of quick gains, overlooking traditional risk analysis. Prepare to uncover valuable insights and lessons from the history of speculation, potentially informing your understanding of today's investment landscape.
The psychology of speculation. Speculation involves pursuing short-term opportunities and forecasting the market psychology. This behavior can be highly addictive and resembles gambling, leading investors to follow a herd mentality that risks traditional risk analysis. Speculative manias occur when a new industry or technology is overestimated, and too much capital is attracted to new ventures. Investors today are pursuing the internet in the same way they pursued land, gold, and railroads in the past. To differentiate from speculation, investment aims to prevent a lot of money from becoming little. A historical account of speculation. This captivating summary takes us on a journey through the history of speculation, from ancient Rome through the tulip mania to the modern era. Through the ages, stock prices have fluctuated based on economic and social factors, but the pattern of speculative manias remains the same. As people overestimate the potential new gains and too much capital is attracted to new ventures, stock prices soar, leading to speculation bubbles that inevitably burst. These manias are often prompted by the inception of a new industry or technology. Whether it's government securities in the 14th century or internet stocks in the 21st, the euphoria and subsequent bust of speculation remain consistent, reminding us that history has much to teach us about the nature of financial markets. The rise and fall of stock market speculation. The emergence of the stock market in London in the late 17th century brought about a significant era of speculation, with writers recognizing the similarities between gambling and investing. Fraud, known as stock jobbing, arose and led to the 1697 economic crisis, with 70% of all English and Scottish companies failing. This pattern persisted throughout history, where investor optimism was inflated, and only promoters and stock operators profited. The South Sea scheme and the Mississippi scheme were launched, substituting paper currency for gold and inflating the share's value. In the South Sea scheme, the government debt was converted to stock in a company that took over government debt, which created an inflationary spiral for their respective shares. The share prices were manipulated through loans to shareholders, and the company used stock proceeds to lend money to allow new investors to purchase stock at higher prices. Eventually, investor irrationality and company greed created an unstable condition, and just before the stock collapsed, the company offered a 50% dividend to encourage subscription sales. By September, the stock price fell from £800 to less than £200 in 4 weeks, and the bubble collapsed as quickly as it developed. The railway mania bubble. In the 1840s, a bubble of railway mania occurred as writers proclaimed the revolutionary effect railways would have on human civilization. By 1845, 16 new railway schemes were proposed, and more than 50 new companies registered. Many subscribers purchased subscriptions beyond their means, hoping to sell them before taking possession of their shares. The speculative behavior was denounced by writers, and in 1848, the bubble burst. A parliamentary report identified more than 20,000 stock subscribers, but the market value depended on how far circumstances would sustain or increase public appetite for speculation. The stock market crash of 1929. The 1929 stock market crash was the biggest bubble in history. The people of the United States believed that they had entered a new era of limitless prosperity. The Federal Reserve System was believed to be the remedy to any booms, slumps, or panics in the market. However, by 1929, more than 2 million Americans were in the stock market, and millions more were interested. The boom in leveraged buyouts and reductions in income, capital gains, and corporate tax rates fueled the bull market, which led to a speculative euphoria. Psychologists call this cognitive dissonance, where a crowd's intellectual shortcomings show in its ability to filter and manipulate information to fit its beliefs. The crash started on October 24, 1929, causing banks, brokerages, and industries to fail, and stocks dropping so low that no bids were offered. Finally, on October 29, a wave of sale orders hit the market as speculators tried to cover their margin calls, causing glamour stocks to collapse by as much as 75%. The stock market speculation of 1929 became central to the culture, and now serves as a case study for similar bubbles that may occur in the future. Bull market comparison. The current bull market draws similarities to the 1920s market crash, fueled by low interest rates, technology expansion, and consumer credit. Both markets experienced explosive growth in mutual funds and investment trusts. However, the most notable similarity is the reintroduction of the paradigm shift mentality, which suggests a move away from traditional stock investing to new methods or economies. Some argue that the present bull market is also a paradigm shift, rather than a bubble. The new economy concept is gaining traction in financial circles, setting the stage for potential market changes.
In Devil Take the Hindmost, the author uncovers a recurring pattern in financial speculation across centuries and continents, revealing enduring links between inflated share prices, irrational exuberance, and ensuing financial crashes. From ancient Rome to the modern era, the book showcases the role of new technologies and industries in attracting capital and fueling speculative ventures, often leading to excessive investment and eventual market collapse. By comparing historical speculative events with contemporary investment practices, the book offers insights into the psychology and mechanisms behind financial speculation, shedding light on investment bubbles and potential warning signs for future financial downturns. Ultimately, Devil Take the Hindmost encourages readers to develop a well-rounded understanding of the history of financial speculation, so as to make more informed, rational decisions in today's complex investment landscape.